Hey everyone, welcome back to the channel. And first of all, Merry Christmas to you and your families. I just want to take a quick moment to say thank you. The support, the views, the comments, and the messages this year have honestly meant more than you know. I'm incredibly grateful for every single one of you who shows up and watches these videos. And if you've been following me for a while, you already know I love selling options, whether it's cash secured puts, covered calls, or spreads. Those are usually the strategies that we're always talking about on this channel. And while I believe that selling options is one of the best ways to generate income and grow a portfolio, we're switching things up a little, right? Because not everyone has the time or honestly the desire to actively manage trades, roll positions, and watch the markets. So today we've got a special guest joining us, my daughter Ivana from Investing with EG. So Ivana is going to be talking about passive investing today, which is perfect for busy professionals, parents, or anyone who wants to build long-term wealth without being glued to their screen. So Ivana, tell everyone what we're covering today.
Hi everyone! Today I'm sharing 4 ETFs that I think can help almost anyone build long-term wealth in simple, low-maintenance ways. These ETFs give you a really strong mix of US stocks, international stocks, a tech-focused ETF, and a dividend ETF. So you're diversified. You're not trying to time the market, and you can pretty much set this up and let it grow over time.
So let's talk about your first selection, which is VU. This one gets mentioned a lot. Why did you include it in your selection?
VU tracks the S&P 500. So you're basically investing in the 500 largest US companies. You're getting exposure to companies like Apple, Microsoft, Amazon, businesses that already dominate their industries.
And let's talk about the expense ratio. The expense ratio is pretty low, right?
Exactly. It's extremely cost efficient, which matters a lot over decades.
So again, for someone who doesn't want to pick individual stocks, this is kind of a no-brainer.
Exactly. It's a core holding.
So again, that would make VU a strong pick for somebody who wants to invest passively because they get to capture all the big names in just one single ETF.
On my Fidelity Youth account, I actually have an automated thing that adds money to VU every month.
That's good to know. Let's move over to your next selection. So for the next one, I see that you chose VXUS. A lot of people skip international exposure. Why do you include that one?
That's actually the exact reason why I included it. VXUS gives you exposure to stocks outside the US, Europe, Asia, even more.
That's pretty smart. So if the US stocks have a rough stretch, you're not fully dependent on them.
Right, it smooths out long-term volatility.
So give us a quick summary of the VXUS ETF and the holdings that it comprises of.
So the expense ratio of VXUS is 0.05% and the 10-year average returns is 8.04%. There's a bunch of different holdings, so you may be familiar with some of these, but here are a few. ASML Holdings, Alibaba, Samsung, SAP, SE, and Nestle.
That's pretty awesome. This is a great ETF if you want to diversify your portfolio beyond the United States and include some international heavyweights to balance your portfolio. Let's talk about your next selection.
Yes, QQQM focuses on tech and innovation-heavy companies. You're getting companies like Apple, Nvidia, Microsoft, Tesla, businesses driving future growth.
And you chose QQQM instead of QQQ, probably because of the lower expense ratio.
Exactly. QQQM is designed for more long-term investors.
So obviously this adds more growth to the portfolio, but it's going to be much more volatile because it has a lot of tech names.
Yes, but when you combine it with ETFs like VU, it balances out nicely.
All right, that's great to know. So give us a quick summary of QQQM.
So QQQM has an expense ratio of 0.15% and a 5-year average returns of 16.45%. And then holdings, as I mentioned before, include Nvidia, Apple, Microsoft, Amazon, Tesla, and even more.
All right. So again, this is a great selection if you want to balance your portfolio with the tech sector and choose QQM over QQQ because obviously its expense ratio is a bit lower. Let's talk about your last selection.
So my last selection is SCHD, Schwab US Dividend Equity. SCHD focuses on high-quality dividend-paying companies. These are companies with strong cash flow, solid balance sheets, and a history of paying and growing dividends.
So this would make a great ETF for people who want to generate income without selling covered calls.
Exactly. It's passive income without active management.
And obviously, over time, reinvesting those dividends can also be very powerful.
Exactly. It's perfect for long-term compounding.
So give us a quick summary of SCHD.
So SCHD has an expense ratio of 0.06% and a 10-year average returns of 11.40%. And there's a ton of holdings, but some of the big names you might be familiar with are the Coca-Cola Company, Pepsi, and Verizon Communications.
All right. Thank you, Ivana, for giving us a quick tour of your 4 favorite ETFs.
If you enjoyed this video, check out my channel, Investing with EG, for more passive investing and long-term wealth building content, along with a few trading challenges.
All right. Thanks, everyone, for tuning in. We'll see you in the next one. Merry Christmas and happy holidays.